Hi, my name's Sarah. Welcome back to my channel. I am a mortgage broker and I have a channel which shares mortgage information and tips with you all. Really just to share my knowledge with you and help you through what can be an absolute nightmare journey nowadays, with mortgage lenders' criteria changing, obviously Brexit, COVID, you name it. There's been a lot of changes in the market, and a broker is very well placed to help you navigate your way through that, saving you time, money and credit checks. So yeah, in my opinion, we're well worth it, but you know, I'm just saying. Anyway, welcome back to my channel. I'm in the middle of a new series, which is Residential Home Back to Basics. It's just designed for the newbie out there, the first time buyer, the person remortgaging, the first time landlord, anybody that's just newer to property, not had a mortgage for a while and just looking to recap and find out what the latest criteria is really. This series is going to be about property that is suitable for mortgages, what to look out for, what lenders don't like. So if you're looking at properties at auction or any properties that are maybe under market value for a certain reason, then this mortgage video is for you. If that's something you think you'll benefit from, keep watching. Okay, so is your new property suitable and things to avoid? Okay, so I'm just going to say them as I think of them. So first of all, let's go auction. So you're buying at auction, always read the legal pack. Why is this property at auction, especially in this market where everything's selling really fast and for a premium? Why is the property gone to auction? The likelihood is it's unmortgageable. And there are some reasons for that. First of all, if it's a flat, we first need to find out what the lease is. So the lease length of a flat can be normally 99, 125 or 999 years at the outset. And as those years progress and the term of that lease reduces, they become less valuable and less of interest to the lenders. So when you get down past 80 years, you should be starting to think about renewing that lease. Renewing the lease is probably a video I should do on its own, but very simply, you do have to own the property for 2 years before you're able to apply for a lease extension, unless the person you're buying from has owned it for 2 years and they start the process. They can then transfer the process to you. Now, this is legal remit, so that is just what I think. It always used to be that way. It may have changed, so don't take my word on that, but that's just a guide, something just to look out for. And ask your solicitor about if this property you're looking at does have a lower lease. Now, there are some lenders out there which will go down to sort of a 50-year lease or up to 65-year lease, but you know, if you're down there, it's going to be really difficult to sell the property and to mortgage the property. So yeah, I would say anything below 80, you need to be thinking about extending that lease. What happens if that lease was to run back to zero? Then that property would lose its value completely and it would revert back to the freeholder. So you don't want that to happen when you've paid for it. So it is in your interest to renew it. And they used to say that anything that the lease costs, is sort of a third of the value you would add. So you will add value to that property by extending the lease. So yeah, lease, always look out for a lease on a flat. A house, 9 times out of 10 won't have a lease. They're freehold. And obviously a flat will have a lease, and I'll do a leasehold video separately so I can explain what a lease actually is and why they're in place. But yeah, watch out for a low lease. Second thing is obviously something structural. So, I mean, has the property had subsidence? Has it got a lot of damp? Has it got any damage? Does the roof need replacing? Is there a huge crack from a window to a floor or something like that? Something structural. A lender isn't going to want to lend if that property isn't sound, and they will obviously instruct a valuer to come around and make sure that it's sound. So it might be that somebody's tried to buy it with a mortgage, it hasn't gone through because of that, and they weren't in a position to spend money to rectify the problem, and it's gone to auction. So yeah, structural is definitely something to look out for. The other thing I would say is construction type. So a standard construction would be brick, tile or slate roof, and the non-standard construction would be more like timber frame, stone, a high percentage of cladding. So yeah, anything that's deemed non-standard construction. There are some lenders that will do non-standard construction, and nowadays with the green mortgages, we are seeing more and more timber frame properties and more environmentally friendly structures. So over time the lenders will become more and more lenient on this, but at the moment check the construction type, because you will be limited to lenders if it's non-standard construction. The other thing to look out for is a high percentage of flat roof. Lenders don't like this. They're normally happy with a small percentage, but if there's a large percentage of a flat roof, or the roof is flat, which we do see now down south especially, in a lot of sort of modern builds, they do have a flat roof with sometimes a little garden terrace on top. Lenders don't love this, so definitely make sure you do your research before the hammer goes down or before you agree to purchase this property. If there's an element of a flat roof, you need to find the right lender for you. The other thing is some of the council owned or ex-council right to buy properties that come up in London have something called an open access balcony. So I don't know whether you've seen, you probably have, as you go certainly into Waterloo on the train, there's a lot of council owned or ex-council blocks of flats, and along the front of the whole building is a balcony that runs all the way along the front with all the individual flat doors, so that somebody that lives at flat number 10 at the end has to walk past all of the numbered flats to get to the access out. That's called an open access balcony. Again, a lot of lenders don't like that, so do your research if you are thinking of purchasing a property with an open access balcony. High story buildings as well, watch out for this. The lender will always ask how many floors are in the building, what floor the flat is on, is there a lift, and yeah, so make sure that you've done your research, that the lender you're wanting to use will accept a high-rise building or a flat where there's a certain amount of floors in the building. And these are really for fire risks and sort of saleability. So is how many people are going to want to buy at the top of a high-rise building. Again, nowadays they're becoming much more modern, and there's a lot more people looking at purchasing these, but just do your due diligence. Don't assume your lender is going to lend on this. Cladding. So obviously with the disaster that happened with the fire in London, since then there's a certain type of cladding that lenders won't lend on at all. And we have had a couple of mortgages where developers had already used the same cladding and these properties were turned down. So yeah, this caused quite a lot of expense for developers that had to backtrack and change the cladding that they'd used to make their properties mortgageable. So yes, if there's a certain amount of cladding on the building, do make sure that it's the cladding that is acceptable to the lender. And again, in these modern builds, you are seeing sort of decorative cladding over brick, which is normally fine. Like a small percentage of decorative cladding over brick is normally fine, as long as it isn't the type of cladding that's a high risk of fire. What year was the property built? If it's a new build or within 10 years, then it will be expected to have a warranty by a well-known sort of reputable company. So make sure that if it's a new build, it does have the warranties in place that it needs. These are normally 10 years, last for 10 years, and the lender will want to see these. A property that's had some work done to it, maybe it's had a loft extension or an extension at the back, maybe it's had a loft conversion or an extension to the kitchen. Any work that the property's had done to it, just make sure that they had the right planning permission to do that work. It's not really that the lender won't lend, but their legal team will pick this up, and that could cause you problems further down the line. So just make sure when you're making your offer that you have asked the question, that the correct planning and building regulations were in place, and that they can show those certificates easily. Freehold flats. Okay, so lenders don't like these. A lot of people, again, I think it's a bit of a myth that people feel that if they have a freehold flat, that stands them in better stead for the lender, but actually it isn't the case at all. And the reason for this, very quickly, is a lease really does line out the ownership of the flat, so the lender knows exactly what the owner of the leasehold flat is responsible for. So you own the ceiling and you own the floor and everything within that flat, and the freehold owns the outside of the building, the stonework, the roof and the ground that that flat sat on. So it just really, everybody's clear who owns what, and that's why a lease in a flat is something that the lender likes. A freehold flat can be a very grey area as to who owns what and make it quite difficult for the lender to repossess the property if they needed to, or if any work was needed doing to find out who's actually responsible for that and protect the asset that they're lending on. So that's the reason why. There are one or two lenders that would consider a freehold flat, but not many at all. You might find this situation in a house that's maybe been split into two flats. One of the flats was a lease was created at the time it was sold, and that left the one flat just as a freehold. So again, I have done mortgages on these types of properties before, but it definitely does close down the lenders that you can use. Just something to look out for. Just leading on from that, if you owned those two flats let's say you had a house, you split them into two flats and you owned two flats, you lived in one and rented out the other one, and then you wanted to refinance one of them, so they were coming to the end of their mortgage term, for example, we have to find a lender that's happy with exposure levels. Now, if there was a block of 4 flats, let's say, it's very normal for lenders to only want to lend 25% of that block, so they'd be comfortable to lend one flat in that block only. So when there's 2 and obviously you own 100% of it, or even just one, so 50% of that block, it can be harder to find a lender, so that's something to look out for. Or if you're a landlord watching this, you might be progressing from owning one single house buy to let to owning something like a multi-unit freehold block, which might be a block of 4 or 6 or 10 or however many, and all the flats within that block do not have individual leases, so you are actually buying the whole of that freehold block. There are lenders for that, but they're more sort of commercially minded lenders. So some of the bigger buy-to-let lenders, stroke commercial lenders, we'd be doing multi-unit freehold blocks, which is one loan on the whole block with all those individual flats sat within it. And that's normally for a landlord that wants to keep it like that and rent all those individual flats. So yes, that is fine to do on a buy-to-let basis, but yeah, just swinging back to residential, if it's just 2 flats or you own 1 or 2 in 4, then just make sure exposure levels with the lender that you're going to do fit. Yeah, I think that brings this to a close. Obviously, if you are very close to a flood area, that's going to come up in the legals, but 9 times out of 10, as long as you can get an insurance company to cover and provide building insurance, the lender would normally be happy. There might be something that comes up in the legals, like an extra insurance, an indemnity insurance, for example, that just covers the lender, but normally if a building insurance company will provide cover, then the mortgage lender is happy with that. But yeah, something to look out for. If you're buying right next to a river, you might find it really difficult to get a mortgage. But I think that brings us to a close. Anything I've missed, please ask a question below. I'd be happy to help and answer it if I can, but hopefully that's given you a good steer as to what the lenders like and don't like. So I'll see you in my next episode. Bye.